Hello friends, this is Raj Sastry from Raj Option Trading. Today is March 20, 2022. Let's take a look at Coupa Software, ticker symbol COUP. Stock tumbled big time after the earnings announcement. These folks are leaders in the business spend management. As we all know, in addition to growing the top line growth, companies have to focus on the bottom line growth also. That's where Coupa Software comes in. They got this cloud management platform. They will help you to really manage your spend across procurement, payments, and supply chain, and so on and so forth. And they got a great platform. They got applications and business spend management platform, and they have wide communities. So with that, let's take a look at Coupa Software and see if it's worth buying after this huge big drop. So with that, let's jump in here. Look, Coupa Software is a leader in business spend management, and they're somewhat similar to Salesforce. Salesforce will help you with the top line revenue growth, whereas Coupa Software will help you with the bottom line margins and bottom line spend management. So as you can see here, Coupa does really well when it comes to spend management, looking at various expense categories like sources to pay, travel and expenses, supply chain, and so on and so forth. And as you can see here, many companies use both Coupa for the bottom line and spend management, and Salesforce for the top line revenue growth and really reach to more customers using their state-of-art CRM platform. So this is really a good combination here. When I say combination, I mean companies typically use both Coupa as well as Salesforce as they go to market. So with that, let's go into a little more details here. Look, from a platform perspective, they got a nice platform here with the communities platform here, which is a cloud-based platform. They got various applications to manage inventory, supply chain, and so on and so forth. So in their platform, they got more than 2,500 customers, 700 million plus suppliers. Look at the spend here, 3.3 trillion plus under spend management. It's a massive spend management. They help a lot of Fortune 500 companies to manage their spend. It's a global company, and they got a lot of patents and also a lot of consultants who help to really help all these companies to manage their spend and tighten the belt. So with that, let's jump into recurring revenue. Look, their revenue is growing very nicely. Look at the pace here, nice clip. I like the clip here. They're growing their total revenues very nicely. And look, most of the revenue is really subscription revenue. The blue part here, as you see here, all this blue here is subscription revenue, and subscription revenue is growing at a nice clip, as you can see here. And the light blue is really professional services and other revenue, and that's also growing nicely, as you can see here. But the bread and butter, their cloud and software platform, that's growing very nicely when it comes to annual revenue. And look, from a revenue growth perspective, it's a nice clip when it comes to year over year revenue growth here. The subscriptions are really growing nicely year over year. So that's why it's a great play here. Let's really look into a little more detail and see if it's worth buying up here. So look at the customer base here. Look, we got a lot of great big customers. We got Darden, it's a restaurant chain, as many of you know, and we got companies like Angie. And as you see here, we got Salesforce.com, which is a big customers of theirs. And we got various other big customers, as you can see here. And we can see here, we got Barclays, Tupperware, all big companies, as you can see here. P&G here, Procter & Gamble, which is a Fortune 500 company. And we got Walmart here with their massive supply chain. They use Coupa Software to really manage their spend and supply chain related spend here. Look, we got Toyota, United, all big companies using Coupa Software. That's a good to know. And as we go into a little more details here, look at the CEO here. We got CEO here, Rob. Looks like he's doing great job. He's got 92% approval rating, from his own employees. That's a very good accolade here. Management is doing right. Looks like Rob knows how to lead the company, and employees seem to approve him. That's a great story here. Management checks out. All right, so now let's look at a couple software companies which are beaten down big time. Look, we got a few companies here. Coupa Software at the top here. Look, RSI is very low, 39. It's the lowest of the bunch here. That tells you this company completely sold off here. And look at the drop here on a 5-day, 10-day, 1 month, big time drop. Long-term story still intact, nice 283% growth here. And right now, from a growth perspective, they're in the middle of the rank here between software companies here, and also industry valuation perspective, it's a low valuation here. Profitability is not there yet, given it's a small company spending big time on their own product. As you can see here, the net margin is negative at the current time. So with that, Coupa is a compelling play here. The current ratio is a little bit low here, but it's manageable. Typically, I like when current ratio is more than 1. Right now it's 0.8, but still it's a good company. Look, Altman Z-score is also a little bit low here, but company doing well. I think we can take a risk on this company here, given it's a growth company, and they got a long way to go ahead and become the leader in the business spend management. And we got a few more here. Stocks are sold off here. Look, we got Mime. I like this company. It's a very good company. It's a nice trading stock. Stock goes up and down nicely. And it's also industry leader. This is also a good one to buy. Given RSI is 40, completely sold off. And we got Norton. Many of you noticed here. Norton also got clobbered last week when their acquisition fell through the cracks. So that's why stock came down. It's also a good buy as we go forward. And we got Adobe here, one of my favorite stock. Shantanu Narayan is the CEO. He's doing the right thing. They got Creative Cloud. It's a great one to buy and hold for the long term. And we also have Trade Desk, which is one of my favorite. Also, Autodesk is a great one to buy. Black Knight, steady Eddie stock here. And we got INTU, which is one of my favorite. You could buy this one also. All these names, as you can see here, completely beaten down here and good to buy at this time and hold it for a while. Look at the long-term story here, all doing great. And look at the valuation. From a valuation perspective, Trade Desk is a little bit pricey, as you can see here. And Adobe is the next, but it's, Adobe is still okay. It's not too pricey, but Trade Desk is a little bit pricey. But look what's going on here. In the short term, all these stocks are going higher because they're down so much. They can only be down for so long. That's why they're going higher. I say if these stocks get beaten down again because of this Fed and Russia, Ukraine, go and buy. They will do well long term. All right, now let's look at leaders in the software area here. All these companies are organized by market cap. Look at the company at the top, which is Microsoft, biggest market cap in the software name here. $2.2 trillion market cap, and from there onwards, it's in a descending order, as you can see here. All these companies have done great when it comes to gross margin. Look, nice gross margin, and they also have a nice sales growth in a 1-year time basis. It tells you it's a little bit stabler companies here, except AZPN here. All of them have got nice positive sales growth. From a net margin perspective, many of these companies have got positive net margin. You can go after them and buy. Wall Street loves positive net margin companies. At the current time, they don't like negative net margin companies. But regardless, companies like Team, which is Atlassian, and Palo Alto Network, they seem to do well despite of their negative net margin, because those are the growth companies growing nicely. And here we got our favorite company, Coupa, which is which had gone down drastically. So we can look at this company here and see. And look, from a 1-year perspective, some of the companies are beaten down here. We got Shopify and Square. Both are beaten down on a 1-year basis, as you can see here. We could slowly buy them. I've been buying Square and Shopify a while ago, and looks like they're doing very well now. I think it's good to wait a little bit now, given RSI is a little higher. I would buy if the RSI is lower, and below 50 is a good time to buy these stocks here. But as they go above 50, I'll be waiting and watching for them to come down a little bit. All right, now let's look at Coupa Software in a little more detail. Look, we got Coupa Software here. Stock is at $90. And look at the 52-week range here. It's in a lower quadrant in 52-week range here, barely above 52-week range. That's when we come in, buy, and hold for a long time. And look from a stock chart perspective, this is a 5-year chart. Stock is doing pretty okay here. Look, we have a nice huge drop here, a nice support level here. That's why I think it's a great time to buy some Coupa here. From here onwards, they can slowly go higher. There's a nice support at around $90 or so here. And from an analyst perspective, as you see here, right now analysts are saying go buy Coupa Software. We got 7 strong buy and 2 buy rating and few hold, as you can see here, and 1 strong sell. I say it's a good rating here. I think I agree with these analysts. It's good time to slowly start buying some Coupa, given it's a good company and growth company. And look from a stock perspective, from overall quality perspective, it's a 44 right now compared to industry, which is 49, a little bit lagging industry. But from a gross margin perspective, also slightly lagging the industry. But I think at this time, mainly it's because of stock, falling down off the cliff, and this company still is not profitable. That's why you see the score a little bit low here. But it's a growth company, early stage company, growing and making sure their platform is very good. That's why you see the scores a little bit lower compared to the industry. Especially look at gross margin, operating margin, net margin. The last 2 here, operating margin, net margin are negative, given the company is focusing on the growth and not to show the earnings at this time here. So, and if you look at the growth here from a future perspective, look here from a sales growth next year, they beat here. They're doing nicely compared to the industry. Industry is at 17%, and this company has a growth 22% for next year. That's a very good growth trajectory for next year. And from an earnings per share perspective, look here, they got a nice earnings per share growth for next year, 100%. And when the industry is just doing 20% here, so it's got nice expectation, for the future. I think it's a good one, especially given stock is sold off here. All right, now let's look at Coupa in a little more detail. Look, Coupa Software, $90 stock right now, and it's a high beta or a high octane stock, as you call it, with the beta of 1.49. It goes higher or lower, about 1.49% compared to S&P 500. The stock price right now is 90, and look, target price is 193. It's more than double the current price, and it's down 68% from its 52-week high. It's in a correction territory right now. It's in a punishment zone, and it's up nicely from 52-week low. And as you scan through here, we got a nice gross margin of 54% here. Net margin and operating margin both are negative right now. Companies focusing on their growth, as you can see here. And nice revenue growth here. It's a growth company. Nice EPS growth for 1 year as well as 5 year. Revenue growth here. That's a good growth story here. And as you scan through here, earnings per share perspective, it's negative right now. Company is not showing any earning. They want to grow and invest in their own platform. Price to sales ratio perspective, not too expensive. It's manageable. And nice future growth here. Both earnings per share as well as sales growth is positive for next year. That's a good sign here. And look, from a debt to equity perspective, it's 1.70. They do have some debt here, but they got a lot of cash, as you can see here. That's a good story here. And they do have some debt, as you see here. They're paying down the debt, which is a very good story here. And they have free cash flow positive. That's a good sign here. And look, from a return perspective or a performance perspective, stock is down big time. Look, 5-day 8.8%, 10-day 20%. It's all negative when it comes to performance, but long-term story is intact. This is where Wall Street kind of really punishes the stocks when they give weak guidance. That's what's going on. Stock had a good EPS surprise and revenue surprise, but guidance was weak. That's why it got punished big time. Stock plunged. From an RSI perspective, relative strength index perspective, it's 39. That tells you stock is really clobbered here, oversold. That's when you buy slowly and accumulate. And if you're a put option seller, you could make some good money selling put options underneath the stock price and earn some premium with the high IV percentile. Put call ratio is 1.19. That tells you we have both calls and puts almost equally. Folks are really wondering what to do with this stock here. That's why they're hedging and buying both call options as well as put options and more put options. That's why it's more than one here. And from a Piotrowski F score perspective, books are okay, not great, given it's a growth company, not showing any profit at this time. From valuation perspective, it's a low valuation compared to industry, which is good. Growth perspective, middle of the road here, and profitability perspective, it has long ways to go. And from a Morningstar perspective, it gets a grade C in finance and growth here, and grade F in profitability. Understood. Arthman Z score is 1.2, tells you books have to improve, given it's not profitable yet. That's why. All right, so with that, let's jump in here and look at the numbers. From a numbers perspective, look from an earnings per share perspective, trajectory is negative here. That's one of the reasons Wall Street does not like it. Company wants to grow and invest in their own platform. That's why they're not showing any earnings. Look at the sales. I love this clip here. From a sales perspective, companies really doing well, knocking the ball off the park here. That's a good story. And shares outstanding perspective, it's going a little higher, which is okay. It's not too much high. Given this growth rate here, I'm okay with the slight increase in the shares outstanding, and slight dilution is okay here. And now on the flip side here, from a operating margin and a net margin perspective, look here, the trajectory is really on the downtrend here, with the margin going down here and also net margin going down. This is one of the reasons Wall Street does not like it. The moment companies says they want to invest in their own platform, that's when they will take the hit on the margin side, even though sales is going gangbusters. Because they're spending on their own platform, the margin goes south. That's why Wall Street does not like it. But companies like Coupa, they got to do it. If they don't spend on their own platform, they cannot sustain and they cannot scale. That's why companies taking some calculated risk and investing in their own platform here. On the positive side, I love the debt to equity here. Even though it went higher in the beginning, now look what's going on. Companies paying down the debt here. That's why debt is coming down. That shows companies fiscally responsible. That's a good story there. All right, now let's look at the earnings history. Wall Street loves the earnings and surprise in the earnings. Look, company has been beating on the earnings per share side and consistently giving a positive surprise here when it comes to earning. That's a good story. The moment you string a couple of great quarters, stock will take care of itself. And look from a revenue perspective, they're also beating the revenue nicely on a quarter-over-quarter perspective. Wall Street loves this also. Right now, when they announced this quarter here, which is January 22 quarter, last week, they gave a little bit lower expectation because they want to beat the expectation 3 months from now. That's why they gave a lower expectation, given the geopolitical tensions, the supply chain issues, inflation. Companies like Coupa cannot give an upbeat expectation here. That's what's going on here. But they want to beat the expectation next time around. That's why stock came down. That's why I think at this time it's a good time to buy, given their track record, which is impeccable here, great track record. They want to keep the track record by lowering the guidance for next quarter so that they can beat it handily. All right. Now let's look at the technicals here. From a technical perspective, look, we got stock chart here. Stock did gangbusters very nicely up to here 2021 April or so. Now look what's going on. From April onwards, we got a couple of months here where stock came tumbling down big time. So this is where we got to see if it's worth buying here. Look, there's a nice base somewhere here around 60. I think it barely hit that level and it's going higher. So this is a weekly 5-year chart that tells you off-late stock is really giving back here. Given Wall Street does not like companies without any profit margin. And now let's look at a little more detail here. From a detail perspective, look, we got Coupa Software. Look, stock is coming down as you can see here in the near term. But look what's going on here. After the earnings announcement, stock came down big time. Now it's slowly starting to go higher. That tells you This is a bare minimum here, or it's a good support level around say 85 or so. From here onwards, you can see stock moving higher because it can only go so low. It's a good company and trying to do the right thing here. That's why it's going higher now, bouncing back. Relative strength index telling you momentum is going higher right now. Even though it's low right now, I can see this going up nicely. And from an implied volatility perspective, it came down. This happens after the earnings. IV percentile comes down, implied volatility comes down. Even up here, it's a high implied volatility. You could still make some good money selling some put options underneath the stock price here. Look what's going on the DMI chart here, directional movement index. Red line wants to come down here, blue line wants to go higher. I can see this going into a bullish crossover here. That will be a good sign here. And folks are buying the stock, evidenced by higher volume and on the balance volume going higher. That's a good story. Smart money is pouring in right now. That's why it's going higher. So overall, even though quarter was bad, quarter was good, guidance was bad, stock got clobbered, it's going higher, bouncing back. That's a good story here. All right, from a options perspective, as you can see here, we got open interest. As you see here, there is a nice open interest. If you see here, even up here at a higher price here at 170, 175, we got nice open interest. Even at 195, there is nice open interest here, 133. That tells you folks are buying call options in the options market here. And there is also some put interest, as you can see here. So folks are really trying to see what to do here. They're buying call options, they're buying put options, hedging themselves. So on an overall basis, as you see here, on an overall basis, look, we got a put call ratio or a PC ratio, as you call it. It's right now 0.8. That tells you there's more call options here, around 11,000 contracts compared to put, which is around 8,900 contracts. That's why right now at the current time, it's a bullish in the options market. Folks are buying more call options than put options. That's why it's a good story when it comes to options market. Options market is telling, hey, buy some call option or buy some Coupa software stock. All right, now let's look at what should we do now? Look, Coupa Software, they beat on the quarterly earnings here. They beat the EPS, earnings per share, by 14 cents here. They beat the revenue by 18% or $7.11 million. That's a good earnings here, good call. But what happened? Coupa Software crashes 30% of the weak guidance. The moment you say investment and little bit weaker guidance because of geopolitical issues and inflation, that's when Wall Street punishes the stocks. That's where we jump in and buy slowly, given the company is a good company. And look, from a looking back perspective, CEO tells us, the core business is really strengthening. It's very healthy, and the new business is growing more than 60% compared to fiscal 21. That tells you, company is doing nicely. They're, doing new businesses with new logos, and they're bringing in the new customers. That's a good story here. Business is rock solid. They're growing. And shares crashed here big time here after they really did not give a good guidance. At this market you cannot give a good guidance. This company is known for under promising and over delivering. That's why they would rather take the hit right now and give a little bit lower guidance, and not to surprise in the quarterly result next time. And look now, what analysts are saying is, what CEO and the CFO are saying is, they want to continue to invest in their own business and drive the growth here. That's why they want to invest. The moment they want to invest, that's when margins will get a little bit impacted because they're really investing in themselves versus returning it to shareholders. That's why margin wise there could be some hit here, and there could be some dilution because of this. Wall Street does not like these words here. The moment Wall Street hears investment and dilution and potential margin hit, that's when Wall Street freaks out and punishes stock big time. As you can see here, 30% on the weak guidance. And what analysts are saying is, healthy business here. It's continue to grow here. They are closing the business on a nice, good basis here. So, because of visibility here, nobody knows what's going on here because this company is into bottom line spend management and areas like supply chain spend. This is where when the companies are hit by this geopolitical tension, they might tighten their belt. That's why they want to give a conservative guidance. So I think stock is overly punished here. They're giving a conservative guidance so they can really hit the mark and do very good compared to the guidance next time. So I think companies really punished very hard here. I recommend buying the dips. This software company, Coupa Software, will do well in the long run. I say go buy some Coupa, take advantage of the dip and go from there. So with that, thank you very much. Happy investing and trading. Please subscribe.